Thank you. Good afternoon, ladies and gentlemen. This is going to be a long speech, but don't blame me for that because your CPT counts. It's 1 hour. So, and having Colin interview me or questioning me, I try to reduce that as much as possible. And so that leaving me at least half an hour for the speech. So here it is, my pleasure to be speaking to all of you. And in fact, before lunch, the mingling, I always said this is my favorite crowd. I meet people from different sectors, whether it's investment funds, wealth management, or crypto, but you all come together. So I think it is a great honor to be addressing my favorite crowd at this event organized by the Hong Kong Securities and Investment Institute. Today, I will touch on a range of topics relating to the structure of our stock market, our efforts to rid the market of practices that are harmful to retail investors, and our vision to build a healthy ecosystem for the sustainable development of the small cap stock segment. I have spoken on different occasions about climate change and sustainability in the context of green finance, including our efforts to develop an effective regulatory and disclosure regime for the sustainable products in Hong Kong, and our support in the inaugural standards of corporate sustainability disclosures launched by ISSB just a week ago. In fact, many of the climate-related concepts are also pertinent to the sustainable development of the stock market. An important lesson we learn from climate change is the need to properly manage pollutants in the environment that we live and breathe in. These include not only the toxic substances that directly harm our health, but also various carbon emissions and other greenhouse gases which exacerbate global warming and disrupt the balance of the ecosystem. In our stock market, it is equally important for us to control and minimize pollutants in order to maintain a healthy ecosystem. Such pollutants can exist in different forms of market and corporate misconduct, and they can be highly toxic and detrimental to the market. One major pollutant is ram and dump schemes, where fraudsters ram up share prices by various means and then use social media platforms to lure unwary investors to buy illiquid stocks before dumping them. Although it is difficult to quantify the true scale and gravity of this problem, the amount of frozen assets involved in ram and dump cases can provide some insights. About 1.8 billion Hong Kong dollar worth of assets have been frozen under restriction notices issued by the SFC since 2020, involving 10 stocks targeted by ram and dump scams. These assets primarily consist of funds and securities in the fraudsters' accounts, including sale proceeds from dumping stocks to investors. We believe this figure might just be the tip of the iceberg, and actual losses suffered by investors could be much higher. Our investigations reveal that these scams are highly sophisticated. They are orchestrated by syndicates of fraudsters with clear division of labor. And these may include an IPO cornering team. In Chinese, it's actually more conveys it better. It's 上市為非團隊. Responsible for sourcing nominee placees to subscribe for IPO shares and arranging funding for the subscriptions. A market manipulation team, 做市團隊, responsible for creating an illusion of active trading to lure investors and ramping up share prices by controlling the nominees' securities accounts. And then the offloading team, 散貨團隊, responsible for operating social media accounts, this is the best part, including fake accounts with photos of investment experts or KOLs or WeChat girls. And they do have, and WeChat girls aren't girls. To induce investors to buy the stocks from the syndicate at an inflated price and executing the offloading process in an orderly manner until final dumping of shares. We have identified a number of common features in the stocks targeted by these ram and dump syndicates, including low trading turnover and small market capitalization, as it is much easier and less costly for the market manipulation team to ram up the prices of these stocks. We also note that a significant portion of these cases involved newly listed stocks where the IPO cornering team started to corner the shares at the IPO stage and arranging nominee placees to subscribe for shares in the placing tranche. Even though only a minority of small cap stocks in our market are involved in the ram and dump cases under investigation, these scams have caused substantial financial losses to investors and could affect investor confidence. As the saying goes, once bitten, twice shy, or in Chinese, actually a very close idiom for it, 一朝被蛇咬，10年怕井繩. Investors who get burnt once may not return to the market. This in turn can hurt market liquidity and valuation, particularly for small cap segment. Market misconduct keeps evolving and appears in different forms over time. Whilst we take a very targeted approach in our enforcement actions, it is especially important to understand the current structure of our stock market. Over the past 10 years, the total market capitalization of Hong Kong stock market has grown 62%, while the average daily market turnover has more than doubled. The number of listed companies has also grown from about 1,500 to the current 2,600, turbocharged by fundraising records that put Hong Kong at the top of the world IPO league table. The success in primary listings marks a phenomenon that warrants closer attention. In common with many other markets, secondary market trading and liquidity are skewed towards the largest stocks. The top 250 stocks in market cap accounts for the predominant share of total market turnover. Though the small cap stock segment is growing in terms of number of stocks and market cap, they account for a declining share of market turnover over the last decade. At the end of 2022, around 1,100 listed companies, or 40% of the total number, had a market cap of below 500 million Hong Kong dollar. Of these, a great majority had daily turnover of below 100,000 Hong Kong dollar. This phenomenon gives us food for thought. What are the underlying reasons for this? And what are the implications of our market, our issuers, and our investors? Low liquidity of small cap stocks suggests a lack of investor demand. While institutional holdings of small cap stocks are generally low in Hong Kong and elsewhere, the situation seems more pronounced here. This isn't helped by the fact that participation by retail investors in the stock market has not grown in dollar value in the past decade. According to the cash market transaction survey conducted by the exchange, over the past decade, trading turnover attributable to retail investors has been largely stagnant in terms of dollar value, while its contribution to total market turnover decreased from 25.8% in 2010 to 15.5% in 2020. Based on the latest data obtained by the Hong Kong Investor ID launched in March this year, retail investors seem to contribute to about only 12% of total market turnover. Meanwhile, the number of small cap stock listings has been rising in the past decade, resulting in a bigger pool of small caps primarily sharing and competing for the same pool of liquidity from retail investors. Their growth during the 2015 to 2018 period was particularly rapid. There were 290 IPOs of companies with an initial market cap of below 500 million, representing about 48% of the total number of IPOs from 2015 to 18. One of the drivers for the extraordinary growth was Shell Manufacturing. Some business owners whose firm met the minimum cash flow requirement on JAM, or minimum profit requirement on the main board, were willing to incur significant listing expenses on the main board, were to incur the expenses to get their companies listed. These expenses could amount to more than half of the amount raised from an IPO. After listing, the company sold its business back to the controlling shareholders within a relatively short period to create a shell. A new controlling shareholder bought the shell to inject its own business to circumvent new listing requirements, including eligibility, sponsor DD, and disclosure requirements. This backdoor listing process was often done in multiple steps to avoid being deemed as new listing under the reverse takeover rules, and they might be structured in a different sequences. For example, injection of assets into the shell might be deferred to a later date, and in the interim, it might seek to maintain its listing status by investing in financial assets, including shares of fellow shell companies. The incentives for listing were distorted by the value of listed shares during the period. At the peak, shares were reportedly traded at more than $500 million Hong Kong dollar, often more than the value of the businesses themselves. This incentivized some people in the market to engage in the so-called shell manufacturing business. The effect of shell activities was more pronounced on the JAM board, as it is easier to manufacture a JAM shell given its lower entry requirements. As such listings were not driven by investor demand in the first place, naturally trading in these stocks would not be active after listing. Shell manufacturing was often associated with a range of market misconduct issues. As these companies might not be very appealing to investors, some bad actors would arrange nominee placees to subscribe for the IPO shares, creating an artificial valuation and spread of shareholders in the company in order to meet the minimum market cap and number of shareholders at listing. Moreover, as JAM IPOs were not required to have a public subscription tranche back in those days, the shareholders were often highly concentrated in the hands of a limited number of shareholders, including suspected nominee placees in some cases. As such, stock prices could be highly volatile and susceptible to market abuse. In 2015 and 2016, the share price of newly listed JAM stocks increased by about 6 times on average from their IPO price on the first trading day. However, a large majority of these stocks subsequently saw their prices drop below their IPO prices, resulting in substantial losses to investors, especially for those who bought the shares at the secondary market high prices. While we fully recognize that bad actors comprised only a very small part of market participants, such misconduct has caused substantial losses to investors and harmed the health of our ecosystem. Whatever constraints and rules are put in place, it is impossible to prevent all misconduct. Bad actors will always find a way, and it is important not to try to prevent all possible misconduct because such a regime would likely be a serious impediment for legitimate activities and development. It is therefore a question of balance. The evidence of those years suggested that the balance need to be adjusted. As my predecessor, Ashley Alder, had mentioned at HKSI Roundtable previously, the SFC formed in 2016 a cross-divisional working group codenamed ICE or ICE, which stands for Intermediaries, Corporate Finance, and Enforcement, combining the expertise from these divisions to develop and implement an organization-wide strategy to tackle corporate misconduct in a holistic manner. Let me recap some of the outcome following several years of hard work. A huge amount of work has been done on the policy front through amendments made by the Hong Kong EX to the listing rules to address market quality issues and mitigate the risks of corporate misconduct and market abuse. Some examples are as follows. JAM IPOs are now required to include a public tranche to reduce the risk of use of nominees to secure high concentration at IPO. The reverse takeover requirements have been tightened to deter backdoor listings. As well, high dilutive capital raising is made more difficult. The initial listing criteria for both main board and JAM have been raised in 2018 and 2022, including the increase in the minimum market cap for the main board from 200 million to 500 million to position it closer to the main overseas market. Market surveillance and enforcement actions have been stepped up to focus on ram and dump cases, and investigation widened to unveil sophisticated syndicates, as illustrated in the beginning of the speech. Collaboration with ICAC and the CCB of Hong Kong Police as well as overseas regulators, have been enhanced to ensure that bad actors have nowhere to hide. Arrests have been made and assets frozen. Licensed corporations have been reminded of their obligations under the Code of Conduct to report any suspected market misconduct to the SFC immediately, such as nominee placees account opening. Prompt reporting of suspicious activities is crucial to enable the SFC to investigate and take swift action to contain the damage, for example, by preventing the proceeds of potential crime from being siphoned away. Now, following a series of regulatory actions and rule changes, the inexplicable first-day surge of JAM listings has now been history, and it has become much more difficult and costly for backdoor listings to take place. As a result, demand for shell companies has decreased, leading to a sharp drop in shell prices. Together with a heightened scrutiny by regulators in vetting listing applications with red flags, this has led to fewer IPOs of companies with shell futures. The SFC is also prepared to apply its full regulatory toolkit to reduce the risk that small cap, illiquid companies can be used to facilitate market misconduct and cause investor harm. There may be more to be done, but the balance has certainly moved towards a fairer and better informed market. So with that episode of distorted incentives firmly behind us, it is time to reset and refocus on attracting quality small cap companies and achieving sustainable growth of that sector. First, it is useful to consider this in the context of market forces driving changes in the past decade. The introduction of a number of new chapters in the listing rules tailored for the listing of innovative companies with weighted voting rights, biotech companies, and more recently, specialist tech companies, has resulted in a stock market with more new economy stocks with high growth potential. New economy companies now account for more than a third of our total market cap and more than 40% of our total market turnover, compared to less than 20% 5 years ago. Hong Kong has also become the largest biotech listing center in Asia. But we see a clear need to improve the liquidity of small cap stocks on our market to recapture the interests of both institutional and retail investors. It is a challenging task, given the recent history and the current macro environment, but our stock market's fundraising function must be revitalized for SMEs. We need to go back to the basics, restore investor confidence, and the original intent of a junior board for quality growth companies. The budget included an announcement about the reform of JAM, and Hong Kong EX will launch a public consultation in the second half. Any measures taken to revitalize JAM should best be accompanied by a vision and a roadmap to develop a vibrant small cap ecosystem to support liquidity of small caps in the main board as well. It may also need to address upfront the issue of investor demand and liquidity, because adding more companies with little investor interest and low liquidity is unlikely to make Hong Kong's listing markets better. Market participants, including both the buy side and sell side, have important roles to play. To develop a critical mass of quality issuers that will restore investor appetite for small caps, intermediaries, in particular sponsors and underwriters, should serve as gatekeepers of quality and help screen out problematic companies with their expertise in due diligence. Investors, in particular investment managers seeking to deliver superior investment returns for their funds or clients, would follow whatever there are good companies and attractive investment opportunities. Institutional investors' participation will lead to improvement in liquidity and valuation, which in turn attract more quality issuers to list on our market. In addition, they can provide capital to support growth of SMEs at both the pre-IPO stage and after listing. Their participation would also drive demand for research coverage, which is virtually non-existent for small cap segment. This will help improve transparency and efficiency in the market. Last but not least, investor culture has to improve through education. Unwary investors have been lured into the RAM stage because they believe in the tips provided by the influencers who impersonate well-known stock analysts, or by WeChat girls who claim to know they know somebody in the know. Working closely with our subsidiary, the Investor and Financial Education Council, we have been educating investors not to blindly follow influencers or hearsay tips in making investment decisions. With the ever-increasing popularity of social media platforms, this task has become even more challenging. Apart from what we have done in the past, we have brought this battle to the social media platforms where fraudsters spread investment tips to Leung investors, and we are sharing anti-scam information through these channels. These include SFC's official Facebook page and WeChat account. We have also conducted an online campaign which simulated the experience of being drawn into social media investment scams. So now, ladies and gentlemen, I mentioned earlier that trading turnover and attributable to retail investors has been stagnant over the past decade, while the number of small cap stocks has grown rapidly. This has contributed to the relatively low level of liquidity in small cap stocks. There are various reasons behind the phenomenon, but the only way to winning back retail investors is to ensure that our listed or to be listed small cap stocks are free from scams and worthy of investments. To this end, it is important for us to continue our efforts to maintain a clean environment to foster investor confidence, and also for all of you, buy side, sell side, to do your part. We will continue to engage the industry to explore how we can better support the sustainable development of our market. So thank you.
Okay, thank you very much, Julia.